All right, my presentation is going to focus, there will be three main sections. Once, I'll talk about global economic backdrop. Then I'll deep dive into the Singapore economy. And finally, which is the juicy part, I'm going to touch on a little bit about property market, our thoughts, our views on the property market. Not as extensively as what Ismail has done, but essentially some of our thoughts, particularly coming from our own in-house property guru, Derek Tan. I'll share with you more about who is Derek Tan later on. Okay, first thing first, inflation. Inflation has been a key risk that everyone has been very worried about since 2021, all right? And this is the reason why the Fed interest rate has been going up. But since second half of last year, inflation has been coming off, okay? You can look at the various commodity prices in terms of metals, fertilizers, energy prices. Everything has been coming off since the second half of last year. So essentially, inflation has peaked. Even in the US, you look at the chart on the left-hand side, inflation in terms of forecast of all these things, everything has peaked and is actually beginning to come off. More importantly, is the labor market. Now, the Fed has been talking about labor market for quite some time. Now, why is labor market so important? Because labor market, first thing first, is always the last to move. Inflation is coming off, but wage growth is still very strong. There is still a lack of supply of workers. Essentially, companies still have to pay higher wages to get people. So if wages remain high, especially wage growth remains strong, it could actually go into the system and create a second round of inflation. So therefore, the Fed is focusing a lot on the labor market. If the labor market doesn't soften, then potentially we can have more inflation going down the road. And henceforth, the Fed has been very insistent in terms of hiking interest rate and tightening the monetary policy. Now, if you look at the chart on the right-hand side here, well, unemployment rate is still very low. Non-farm payroll, even though it has come off, is still hovering at about 200, 300,000, which is still higher than the historical norm of about 150 to 200,000. So labor market is still strong despite the fact that inflation has come off. However, Fed has hiked very aggressively since early last year. I like the chart that Ismail has put out just now in terms of the quantum of hikes. The good news to all of you as home buyers is this: it's coming to an end. The Fed, in the most recent hiking cycle, has only hiked 25 basis points. I think you guys have read a lot about it on the news just a few days ago. In our opinion, based on our interest rate analyst forecast, the Fed will hike just one last time in the next hiking, the next policy meeting. Another 25 basis points, and we should be done. Okay, that's our house view. Also, you may want to know that based on our analysis, essentially we are expecting Fed cut, interest rate cuts in the second half of next year. We are looking at about 100 basis point interest rate cuts in the second half of next year. Now, some foreign banks have been quite, aggressive in the sense that first they were calling for very aggressive rate hike, and then they were even calling for rate cut end of this year. This is not the view we are taking. We are taking a more cautious view, a more balanced view. We expect that Fed is coming to an end, and if there's any rate cut, it will be in the second half of next year. Now, what does that mean? Essentially, we are not calling for a global recession. I'll touch on a little bit more about that later on. But the truth of the matter is this: with this very aggressive hiking cycle, so what we have seen is that market interest rate has risen a lot. If you look at this area, and you compare to the period during global financial crisis period, essentially our interest rate in the financial market environment, market interest rate has returned back to the same period, same levels that we have seen during the global financial crisis period. All right? Now, of course, what happens is this: it's creating some problem. We have seen over the last couple of weeks, essentially bank failures in the US and Eurozone. Now, so the key questions that most people will ask, in fact, I get asked these questions quite a lot by the journalists, is that, is this really the perfect storm that is brewing, or is it simply the storm in the teacup? There is two very diverse views. But of course, as investors into property, you guys need to know what's going to happen next. And I will share with you this. One big difference between what we have seen during the global financial crisis period versus now is actually the policy response by the central bank. In the past, during global financial crisis, the Fed has been very sluggish in its response. In the European debt crisis, ECB has also been very sluggish. But this time around, the policy action is very swift, ensuring that there's sufficient liquidity in the system and to avert a meltdown. Now, our view is that the risk of a meltdown is still fairly low, given what we have seen from the policymakers so far. But the thing is that we do not discount that you could potentially see a little bit more of this kind of cases going forward. I'll explain a little bit more on that later on. So what I'm trying to say is this. The narrative is still fluid at this point in time. A lot really depends on the policy response by regulators and central bank going forward. They will decide the narrative, what will happen. But there will still be discount incidents going forward because debt ratio is still very high globally. Also, I want to highlight these things. Now, I have been through several cycles in the past, and that what I have observed is that there are three key elements in every crisis. One, there need to be a preconditions. Two, sentiments need to go south. And third, you need a trigger. What we have today is a preconditions. Interest rate is already very high. Sentiments is also not that good because there's a lot of risk aversion, a lot of fear factor out in the market. Every bit of risk, people just get out the door. Okay, these two elements are already there. What is really lacking is a trigger. In our opinion, basically what will happen with SINT in US and Eurozone, those are small trigger. They are not major trigger yet. Why? If you compare to during global financial crisis, we're talking about collapse of Baston's, Lehman's, those triggers are much bigger, all right? And also, as I mentioned right from the start, policy response from the regulators are very important. And this time around, they're definitely done a better job. And what we are seeing from the episode is this. With the bank failures and also high interest rate, what it creates in the financial market is that liquidity conditions is getting very tight. The chart on the left-hand side shows you financial conditions indices and also the tightness in US dollar funding. This is what's happening in the financial market today. What it means is this. Lenders are becoming more risk-averse, less willing to lend, right? Not everyone is like DBS, by the way. So they become less willing to lend. So when they're less willing to lend, basically what it means is that market interest rate, okay, will continue to stay high, okay? And this is not a good thing because of this. If you look at the debt ratios, globally, in China, US, Eurozone, if you look at corporate debt, household debt, government debt, in terms of GDP, it is more than 250%, 250%. Now, this is what I meant back to the earlier point, and that is, if interest rate continue to stay high, liquidity conditioning continue to remain tight, what will happen in the next 2 years is that we will see a series of deleveraging. Deleveraging, what does that mean? Essentially, those people who are heavily in debt, they better jolly well pay off those debt. Those people with weak balance sheet, they will find themselves stuck. And this is where we will get those small little episodes, of cases of bank failure or companies having some liquidity crunch. This is what I mean. For the next 2 years, you're likely to see, bits and pieces, isolated cases of that. And therefore, it is important for policymakers, central banks, to come and step in whenever it's necessary. Okay? US, Eurozone, I think we already seen that, and I think they responded very quickly. The next markets that you have to be mindful of is China. Okay? But the good thing about China is this. Its capital account is closed. In other words, inflow, outflow is to some extent limited. So therefore, that by itself is its most important and in fact the first safeguard to avert a meltdown. And I think the Chinese government is on the top of things because we know the problem in Chinese real estate market for quite some time. We know what's happening in the local government debt as well. But so far, I think the Chinese government has been on top of things. All right? So bottom line is this. Don't be surprised you see a little bit more of this kind of cases going forward because we are going to go through a deleveraging process. But it doesn't mean that we are going to a massive meltdown. Okay? So when you have tight liquidity tightness with high interest rate, what it means is that economic activity is going to slow down. Actually, no need to snap. You can just join the Telegram channel. Everything is there, all right? So what we do expect in the Eurozone and in US is that growth is going to be slower than last year, but we do expect some improvement in the Eurozone going into 2024. The only outlier here is China, and we know China is because of China reopening. So this year growth, we are expecting to, a very strong improvement back up to about 5.5%. All right, and next year, just moderate, some moderations to just 5%. Now, China's reopening is very important for the region, okay? But let's look at some of the China data as well in terms of the pace of reopening and also what we expect in terms of growth. If you look at the data here, it shows you the tourism revenue and traffic percentage of pre-COVID level. We are already back to about 70–80% of pre-COVID level. The reopening is taking effect in a positive way in terms of growth. And also in manufacturing, PMI numbers has shot up very strongly in February. Now we are in the expansion zone. Before that, PMI manufacturing sector in China was in contraction. Now it's back up very strongly. And China reopening is good for ASEAN, and China, in fact, ASEAN will be the main beneficiary of China reopening. If you look at the chart here, it shows you in terms of exports, China is the #1 export market for ASEAN, all right, accounting for 16% of total ASEAN export. When China reopening, obviously, it is good news for the manufacturers and traders for ASEAN. Also, in terms of tourism, China's reopening is going to benefit countries like Philippines, Singapore, Thailand, and Vietnam. In fact, if you go to MBS today, you will see more Chinese tourists as well. Now, from the property market perspective, we know who are the ones that will pay $200,000 per month rental. Okay, so these people are definitely going to come in, and there will be more. Okay. Inflation-wise, in ASEAN, I think the good thing is that most ASEAN countries has already peaked in terms of inflation. The only country that is still struggling with inflation is actually Philippines and Vietnam. So overall, this is the picture that you get. Okay, how do we read this? If you look at the x-axis, this is GDP growth, y-axis is inflation. This is our forecast for this year, all right? And these are essentially the 6 key markets. Red, the size of the bubble shows the size of the economy. Red means deceleration. Blue means acceleration. So in other words, all 6 markets, we are going to see some moderations in growth, but one market is an outlier, and that is Thailand. Okay, so I bought my first overseas property via PropNext during COVID, and now you know the reason why I chose Thailand in my overseas venture, right? Now let's deep dive in the Singapore economy. Well, essentially, this is the kind of economic performance that we've seen recently. Last year, 3.6%, and on a quarter-on-quarter basis, not that good, 0.1%, flat, almost zero, okay? And what is the main reason for that? It's mainly because of manufacturing sector. The manufacturing sector has been on the decline mainly because of China's zero COVID policy. And also global economy, in terms of growth momentum, is also slowing down. Oh, what happened to that? And also, if you look at exports, most recent export numbers at 13 billion essentially is already lower than COVID level. During COVID crisis, 2020, Nordec's number was actually even stronger. So this suggests to you that global demand is really very weak. Manufacturing sector is actually in recession. However, what I want to highlight to you is this. China's PMI, just now I mentioned to you, is bounced back very strongly. In our opinion, is that this could potentially bring about some respite for the manufacturing sector in the second half of this year. Also, electronics-wise, some of the leading indicators, even though it has declined a lot, some of the leading indicators that we've seen recently is suggesting that we are near the bottom of the electronics cycle. Okay, so this chart here is going to change in the second half of this year. when China reopened, and therefore we are able to export more products over to China. Services growth has been fairly flat ever since 2021, when we first reopened the economy. Momentum is holding up, but slowing down, except for hospitality sectors. The accommodation and F&B sectors has done quite well. In fact, this survey here shows a decline, and the reason is because the survey was conducted even before the announcement of China reopening. So I won't be surprised that this index is going to bounce back up in the next survey. And the reason is visitor arrivals are coming off. I mean, basically, the tourists are coming back. And as of now, we are talking about essentially tourist arrivals about 60% of what it used to be before COVID. So there is still a lot of room, right, to improve in that regards. Basically, I'm telling you to buy hospitality REITs. And also SIA. And China reopening, like I mentioned, is going to be big for Singapore. In terms of tourist arrival, 20% of our tourists are coming from China. And also in terms of Nordex exports, we're talking about 18% coming from China. So China's reopening is going to be pivotal for Singapore's economic performance in the second half of this year. Why not earlier? Journalists always ask me, why not earlier? Because for a few reasons. One, I think for the last few months, there's still a lack of flights. Air ticket prices is still very high, okay? This has come off a little bit, but many Chinese have also lost their job during last year's zero COVID. So it takes time for them to find jobs and then be willing to travel again. But this will definitely come back in the second half of this year. So in a nutshell, this year's growth, we are looking at 2.2%. Like I mentioned, I do not discount the possibility that we could see some upside surprise in the second half of this year. Okay, 2.2%, is it really very bad? Actually, not so. If you look at the potential growth rate for Singapore, it's about 2.5 to 3.5%. So 2.2 is just marginally below potential growth rate. And next year, we are looking at growth of 2.8%. Okay, so some improvement next year. Labor market is doing very well, and I think this is a very positive thing for the for the property market. I will touch on a little bit more about that. But honestly, as an economist for more than 2 decades, seriously, I've never seen this kind of number before. We're talking about 50, 60,000 new jobs being added in the market every quarter. All right? And if you look at the chart here, say for example, the red line, job vacancy to unemployed person ratio, what is this? It means basically the ratio of number of job vacancy to the number of unemployed person. Okay, if it's 1, usually the market is basically fully maxed out. But where are we today? More than 2. Labor market is extremely tight. This is a historical high. We've never seen this kind of numbers before. I know you guys probably would look at, read the newspaper and talk about, tech retrenchment. But that is a very sector-specific, phenomenon. Because I personally feel that the tech sector has actually overhired in the last few years. When interest rates were very low, tech stocks was very high, they were hiring people aggressively. Now, essentially, it's a fallback to reality, all right? Overall, as a whole, in the labor market, it is still very strong. If you look at the resident unemployment rate, we are at a level way below the pre-COVID level as well. So all the indicators are showing that the labor market is very robust, very strong. Are still, in terms of jobs and incomes, are still fairly good. Okay? But inflation is a problem. Okay? 3 key drivers of inflation: housing and utilities, food and transports. All right? The good thing in recent months is that we have seen a decline in terms of transports, decline in housing, utilities as well, but food has continued to trend up. Now, food inflation will hit the low income especially hard. Because in terms of the consumptions, the total consumption, food accounts for a big chunk. Okay, so I think the government has to watch this very closely. Overall, we do expect inflation this year to start to ease off towards the throughout the whole year, but it will still stay elevated, because if you talk about 30-year historical average, the average inflation is roughly about 2%. And right now, we are hovering at about close to 6%. Okay, so high inflation is here to stay in the near term. All right? In terms of monetary policy, okay, for those guys who hope that the MAS will strengthen the Sing dollar further so that you can go to Bangkok and spend like a king, sorry, it's not going to happen. The MAS, in our opinion, is coming to an end in terms of its hiking cycle. So this April, we are expecting the MAS to pause. The MAS will not strengthen the Sing dollar any further. And if you look at our senior policy chart, typically this line, when it goes to the upper quadrant, is a signal for the MAS to tighten monetary policy further, strengthen the Sing dollar further. Okay, in Singapore, we don't go by interest rate. Okay, we don't go by hiking of interest rate. It's not like Fed or in Europe or Japan. In Singapore, we go by FX, the Sing dollar. Okay, if it's tightening, that means the Sing dollar will strengthen. If it's easing, that means the Sing dollar, usually they won't ease. Typically, they just put it 0. Okay, which is why Sing dollar is always a safe haven for foreign investors. Okay, which is why you go JB, you feel like a king. You go to Bangkok, you spend like a king as well. Okay, so though, thanks to the MAS, but they are not going to strengthen any further. Okay? Okay, here comes the juicy part. Suddenly I see all the hits, start to wake up already. Well, I wouldn't claim to be a property guru, really. The next few slides are essentially slides that I borrow from our own property guru, Derek Tan. Now, who is Derek Tan for those who are not sure who he is? He's the guy who predicted that the property market in Singapore in terms of PSF, okay, is going to go up to 2003 to 2009, back in 2018. At that time, when you put out a forecast, everyone thought that it's crazy. But where are we today? We are at that level, right, Ismail? Right? Also, Derek is, highly regarded by fund managers as well. Every year in Asia Money poll, which is basically a poll of global fund managers, he has always been rated #1 in Singapore. Okay, not JB or Batam. Yeah. So he's been rated #1, and essentially, the next few slides, I'm going to share with you some of the views on the property market. And also, do note why the QR code appear again, because Derek told me last evening that he has actually went to visit Tembusu Grant. Okay? And he's going to visit another new launch as well. He will be putting up his assessments, his objective view of those 2 projects in the next 1 to 2 weeks. So you can find his assessment in this Telegram channel within the next 1 to 2 weeks. Oh, by the way, I forgot to mention that we're actually having a giveaway campaign. So there are attractive prizes to be won if you join the Telegram channel. Sorry, upon next. I need to steal some thunder. Okay, let me go to it. Can I have a slides? Yeah, thank you. Okay, you guys see these slides, this chart time and again. And I like the chart that Ismail had put up just now, depicting the various stages of the property market. When did I buy my property? Before the spike up in 2006. I was doing property hunting during this stage, during the global financial crisis. And then I bought the property that I'm currently staying around 2017. At that time, I told my wife, it's now or never. Because back in second half of 2016, I remember, in DBS, I called the bottom in terms of academic cycle. I said, this is the bottom. Okay, and the next thing is a few months down the road, equity markets start to rally. Usually it works this way. When equity markets start to rally, the next thing is property market will also rally. So when I called the bottom in the second half of 2016, a few months later, equity market rally, and I told my wife, it's now or never, which is why then I bought my property through PropNext sometime in 2017, second half of 2017. Turned out to be a good decision. I'm still in the money, so very happy with it, and then went overseas as well. Yeah? Okay, what I want to say in this chart here, those small little black circles basically shows you the various rounds of cooling measures that the government has put in place. Also, what is really holding our property market, I think Ismail has touched on that, essentially supply is very limited. We're talking about on average less than 2 years of supply across the board. So our view is that this year, yes, there are some factors, high interest rate is still the dampening factors, but overall, our view is that property market in terms of prices-wise, it will still remain fairly stable, plus minus 3% depending on projects or regions. Stable labor market, which I share with you as well, is one of the key supporting factor. Also, there has been a very strong support coming from the upgraders. Construction costs, I think just now Ismail has touched on it, very sticky, very high, and henceforth there's no reason for developers to price it down because their balance sheets are also very strong. Okay, so all these are some of the supporting factors on the market today. The risk, economic downturn, well, it is some concern, but like I said, we are not expecting recession. We are not expecting a meltdown at all. Also, is there going to be further hikes in interest rate? I also share with you, we think that the rate hike is coming to an end. Okay? I hope I'm not trying to tell you that quickly go and buy a property, but what I'm trying to share with you is essentially our objective view about what are some of the pros and cons, some of the driving factors on the property market. Next thing is this, interest rate. You need to keep a watch on this. Now, as a bank, it is our responsibility to highlight all these things to you. SORA today is about slightly above 3%. If you look at the mortgage rates wise, we're talking about close to 4% kind of a mortgage rate. Okay? Now, one thing is this. Most people will just look at mortgage rate. In economic system, we call it nominal interest rate. But there is a very important concept that you guys, I hope you take it away with you after this seminar, and that is the concept of real interest rate. Now, what is real interest rate? Focus on the chart on the right-hand side. Real interest rate is essentially you take the nominal interest rate minus away inflation. Okay, say for example, if your mortgage rate or market interest rate, SORA or SIBOR, is hovering at about 3%, your inflation is at 5%. So when nominal interest rate minus inflation, 3 minus 5, what do you get? Minus 2, right? Now, usually when real interest rate is negative, it is good for property market. In fact, it is good for most asset classes. Why so? Because imagine you put your money in a bank account. You know, banks are quite giam-siap, you know. They pay you very little in terms of deposit rate, right? Right? So you're actually losing money by keeping your money in the bank, right? Because inflation is higher than what you're getting from the deposit rate, right? It's diluting the value of your money. So therefore, in a negative interest rate environment, people will want to invest to get better returns. And of course, property is one of those asset classes. So here you look at, there is a very nice relationship between real interest rate and property market. Now, when, say for example, during this is 06, this is the period when I bought my first property, HDB. When real interest rate collapse, property prices goes up. When they start to turn up, property prices come down, right? Same here, when real interest rate goes down, property prices start to climb. And this is the period when the government start to impose all the cooling measures. Then real interest rates start to turn, and property prices starts to become sluggish. And here, real interest rate is positive most of the time, property market continues to stay sluggish. Okay, there is some upside here because I think there are some underlying market conditions that are favorable, supporting property prices. Then came the drop. This is during 2020, and again, property prices start to go up again. So there are factors, market factors, economic fundamentals that Ismail has highlighted that are basically influencing property market, but I want to also add on to that, and there is the concept of real interest rate. Okay? Now, the thing is this, when real interest rates start to turn up, it's turning up if you look at here. This explains why our view is that property prices will still remain stable. Not collapse, stable, okay, in the coming 1 to 2 years. And also, we want to highlight to people that there is, basically your mortgage rates has went up by about 200 basis points, about 2%. And if you look at the chart below, for every 1% increase for a $1 million loan, okay, 1% increase for a $1 million loan, your monthly installments is going to go up by about $500. Okay, you have to bear in mind that. Now, higher interest rate, seriously, is, you know, I see the time's up. Higher interest rate is it can be high, it can be bad, but the thing is the real crux of the issue is whether people are overextended or not. Seriously. I mean, interest rate can be high, but if you're not overextended, that means you live within your means, you invest within your means, you are still fine. So what we did is that last year, we did an analysis for 1.2 million of our customers. You know, we have millions of customers. We basically aggregate the data, okay, aggregated, so I don't know how much you're spending, by the way, but we aggregate it. We look at how much people are paying on their mortgage as a percentage of their income. So we derive the mortgage to income ratio by each group and by income group. Across the board, our conclusion is that Singaporeans are fairly prudent. Okay, anything above 45% is actually not good. Okay, anything below that, that's fine. So on average, we're talking about 20 odd, max 30% on average, okay? But there are also some outliers. Okay, and the key thing to note is that if for every 1% increase in mortgage rates, okay, we're talking about 1 million loan for 25 to 30 years, every 1% increase in mortgage rate is going to raise this ratio by about 3 to 9 percentage points. So what it means is that when mortgage rate goes up, those people at the top will get squeezed. Okay? When all of you buy more property, the bank is happy. But if you buy beyond your means, then potentially the bank will be worried. So my word of advice to all of you is this. Okay, invest within your means, live within your means. If you do need financing, of course, DBS will be there for you, and we will definitely, my colleagues over there behind, will surely do some proper assessment and review for you as well. Okay, so don't get angry if we tell you cannot. Okay, we are helping you, okay, as well as helping ourselves. Okay? Okay, finally, for some silver lining, interest rate, we think it has peaked, even in Singapore as well. SORA is near its peak already. Okay, if you look at the 5-year SOR and SORA, this is basically more a long-term interest rate market expectation on interest rate in the longer term. We are seeing some downside bias. Okay, so if you're worried about interest rate going any further, I think that risk has moderated significantly already. Okay, just that really do your math carefully, invest within your means. Okay, that's it. I've come to the end of my presentation, and for those who haven't scanned your QR code, please do so. Sorry, one last thing. And for those who are DBS clients, here is something I can share with you. If you need more research content, investment ideas, update on property market, this is our research portal called Insights Direct, available to all DBS clients. Yes, that means even your TOSB account is good enough. You can join in and get all our free information over there. All right, thank you.
Mr. Irvin Sia, DBS, thank you very much. Mr. Ismail, I'm going to ask you to